Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how dividends impact your retirement income. Specifically, I'm going to chat about a generation of people who idolize dividend investing, 5 blind spots of the retirement dividend investor, the impact dividends have on tax and your government benefits, the importance of coordinating your investment plan with your overall retirement plan, and lastly, as always, a few action items for you to consider. Investing in dividend-paying companies through a mutual fund, ETF, or directly holding stock is a common investment preference for many Canadians, but especially for the cohort of people who listen to my podcast. I hear it time and time again from prospective clients who have a Canadian dividend-heavy portfolio, often directly holding stock, that like to see that dividend paid out. I believe there's a strong psychological aspect to seeing this money distributed that gives retirement investors a sense of security when it comes to investing and their money. That said, there are a number of crucial factors you need to fully understand as a retirement investor who not only wants to optimize their investments, but also wants to minimize taxation. Here are 5 factors you are likely not considering if you are a dividend-focused investor in retirement. Number 1, if you have a concentration of Canadian dividend-paying companies in your portfolio, it means that you are overweight in so-called blue chip stock. From a sector standpoint, you are likely holding the big banks, energy companies, and maybe some utilities. Now, there is no denying that these holdings increase your exposure to value and profitable companies. The banks are really good at making money off their clients. With that said, you're likely drastically overweight in Canadian equities, throwing off your global diversification and leaving your retirement portfolio exposed to this concentration. Now, some may argue, especially after a year like 2025, where these holdings performed very well and the Canadian market as a whole did well. My argument here isn't that these investments are bad, it's that at its core, you are not diversified. Nobody can reliably predict which individual security, asset class, or geographic region will outperform the others. For that reason, we diversify. We diversify across asset classes, meaning that our clients invest in every productive asset class: US equities, Canadian equities, developed market equities, emerging markets, global real estate investment trusts, Canadian government bonds, international government bonds, and investment-grade corporate bonds. The second factor you may not be considering if you are a dividend investor is that dividends are not free money, when in reality, to pay out that dividend, the stock value itself needs to be adjusted down. In a simple example, assume you invest in 2 different companies. Company 1 pays out a $1 dividend per share, and Company 2 does not pay a dividend. Company 1, you would still own 10,000 shares and have received $10,000 in dividends. Your shares are now worth $11 each. That is the $10 starting value plus $2 in earnings minus the $1 dividend. Your total portfolio now consists of $110,000 in stock and $10,000 in cash. Company 2, you'd still own 10,000 shares, but they'd now be worth $120,000. If you needed some cash, you could sell some shares. Maybe you would create your own dividend equal to yours, but you don't have to. You could sell more or less shares as needed. This way, you're not allowing the company's dividend policy to dictate your taxable income in a given year. To build on this point slightly, if you owned company 1 and assume that you don't actually need the money for your lifestyle, this $10,000 in cash is now out of the market, not invested, and not working for you. The third factor you aren't considering, while dividends are tax-preferred income, it pushes all your income into a higher marginal tax bracket because of the eligible dividend being grossed up. This information is crucial when it comes to how your taxable non-registered account is invested. The dividend gross up on eligible dividends is 38%. So if, for example, you earned $50,000 in eligible dividends, the gross up amount would be $69,000. This is the number that shows up on line 12000 on your tax return. Further down the return, you will receive a federal dividend tax credit of 15% based on the same grossed up amount of $69,000. So, for example, say you live in Alberta and the only income you had was this eligible dividend with a grossed up amount of $69,000. Plugging this amount into a simple tax calculator tells you that you will pay no tax with an average tax rate of 0 and a marginal tax rate of 30.5. The last point, the marginal tax rate, is where the rubber hits the road for the retirement investor who have dividends paying from their investments out of their taxable non-registered accounts. Retirees have other sources of income, including CPP, old age security, RRSP withdrawals, RIF minimums or RIF withdrawals, corporate dividends, or maybe rental income. All of this other income may now be exposed to a higher marginal tax rate, driving up your tax payable. So in my same example of a grossed up dividend of $69,000, if we tack on these other sources of income, say your CPP and OAS and maybe some rental income, those sources of income are now taxed at a higher marginal rate because of the dividend distribution. Now, the argument here isn't necessarily that dividends are bad, or even that they drive up your marginal tax rate on other sources of income. The real question is, was the $50,000 dividend even required to fund your lifestyle? Or would you have been better suited triggering tax when it's appropriate for your own circumstances and decumulation strategy? Which brings me to my next point, number 4. OAS benefits are calculated before the dividend tax credit is applied. Specifically, OAS recovery tax is calculated by looking at line 23500 of your tax return, social benefit repayment before adjustments, meaning that a dividend distribution may push you past the OAS threshold, triggering an effective 15% increase in tax. So while your tax payable may remain low, you may still be exposed to losing some or all of your OAS. So I ask again, did you need that dividend distribution to fund your retirement spending? Or was it a product of tax inefficient portfolio construction in your taxable non-registered account that doesn't align with your overall retirement income and tax plan? Lastly, consideration number 5 is just that, not being able to determine your own taxable income. As a retirement income planner, we focus on tax-efficient decumulation. Having a large amount of dividend distributions can make it very difficult to draw down on registered accounts like RRSPs and RIFs tax efficiently. We are now forced to make decisions about your personalized decumulation plan based on what some bank decided to spit out as a dividend at the end of the year. Now, I'm not saying you shouldn't have dividend-paying investments in your retirement accounts, but what I am suggesting is that there may be a more optimal way to structure your taxable non-registered account to help with your overall retirement strategy, all while keeping your taxes low. Retirement planning is complex, there is no question. When we go through our fundamental retirement plan with new and existing clients, this is the level of detail we get into. Everything is connected. So simply picking a few investments without understanding the lasting impact it will have on your government benefits, retirement income, and tax payable means that you're leaving money on the table, or worse, overpaying CRA. Okay, so that'll do it for today. Here are your action items for today's episode. First off, have a look at your taxable distributions from your non-registered account for 2025. If you aren't able to calculate this, you can also look back at your previous year's tax returns to line 12000. Now, the number obviously will likely be different between 2024 and 2025, but it will give you a good sense of the distributions you receive from your non-registered investment portfolio. Is that number materially impacting your marginal tax rate? Next, while you're looking at your portfolio, determine how much of your assets are concentrated in Canada. With strong returns in 2025, your portfolio has likely drifted even more so into the Canadian market. It's time to review and ensure you have global diversification, something all retirement investors should prioritize. Lastly, work with a planner who understands how your investments will impact your overall retirement income and tax plan. Okay, so that'll do it for today's episode. Make sure you add us on all your socials. Make sure you're signed up for our Retiring Canada newsletter. If you haven't done so already, please leave a 5-star review in your favorite podcast app. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.